Hi everybody, thanks for joining. Apologies again for missing Tuesday. We've started this one. Just bear with me one moment. I'm just checking some data that is coming out of Europe right now, and then we're going to get started. Basically, the jobless rate in the Eurozone has risen to a record 11.9%, and we've seen the CPI come in weaker than expected. So that's all quite Euro negative. And we've seen the euro fall actually very sharply, my goodness, back down to kind of fell well below that 130.50 mark, which I'm going to talk about because it's a really key level, and is now testing 130.25. So again, economic data really been a key driver of markets. Let me just bear with you one moment, and then I'll show you my. Sorry, just putting this up. Literally, this is live trading as we speak. Right, I'm going to share my desktop. Here we go. Right, sorry, there you go. That's my Bloomberg terminal. It's not much use to anyone, but I'm going to drag this over here. Brilliant. So, just bear with me one moment. I'm just going to pull you guys up here as well. Feel free to ask lots of questions, but yeah, very bad. Ray's already been talking very bad UK data, large GBP fall. That is indeed true. We had some terrible, unexpectedly bad data out of the UK, which, you know, the UK, the rally was quite fragile. Apologies, I'm still a little bit unwell. But the rally was very, very fragile because it was based on primarily on, you know, a lot of people saying, well, you know what, all of this dovishness is now priced in for the UK. Have we gone too far too fast? We'd have needed something else to push us down, and it seems like we're getting it. We are making some important moves, some very important moves, in fact. And there's a few things I want to talk about. I'm going to start with, if you guys don't mind, I'm going to look at euro dollar, I'm going to look at cable, and we're going to look at Aussie to start with, just to get things moving. So this is euro. As you can see here, let's go on the hourly. We just had weak unemployment data, rose to a record. We've also had inflation fall to 1.8%, so that is below the ECB's target rate. Why is that important? Why do even technical traders need to know about this? Because that all, you know, weaker inflation leaves the door open to some quite aggressive easing from the European Central Bank. Remember, they're the one bank who hasn't done that. Also added to that, some of the wage pressures in places like Germany, they're still very, very low. So that really does open the way now to some more ECB action. So as you can see, fell below that kind of 130.20 low from earlier this week, on the back of that Italian election result. So it's real hardcore economic data. The fundamentals are really driving at the moment. We're not looking we're not looking too stretched either, but this level here, this 130.10 level is 200-day moving average. That's going to be a key support level. I also want to bring in an Ichimoku. Just let me get that up. Hang on. There you go. This is the daily Ichimoku cloud. Those of you who follow the clouds will be kind of jumping up and down right now because we've made a really significant move. 130.80, which is where we were not that long ago, but that was the top of the daily. The bottom of the cloud here. You see that green line there. When you get below the cloud, that is a downtrend. So I like Ichimokus because they're quite easy to interpret. Above the cloud, uptrend. So all of this bit, uptrend, below the cloud, downtrend. And what we've actually seen is just over the last year, just even analysing this price action, is that, you know, the cloud is significant. It's not significant for all crosses, but it is significant for the euro rate. And when it kind of goes, for example, it spent from kind of May all the way to August below the cloud last year. Thus, kind of markets market's view towards the euro can change very, very sharply. So this to me is a real key break. If we get a weekly close below this kind of, below the cloud here, so if we can stay below there all day today and get a weekly close below there, that is a very, very bearish development. Where does it take us to? Well, the first level you've got to look at is this probably I would probably even say kind of 128 zone. So this area here, which would be all the way back to November last year. It's a very bearish development. Remember, it wasn't that long ago that most of us were talking about, you know, the new uptrend in euro dollar, the new, you know, how the euro was it going to continue to stabilize? Well, there were two things that have really triggered, or say three things now that have really triggered kind of weakness from that rejection of 137.20. Firstly, the ECB turning a bit more dovish. Secondly, the Italian election, impasse, the fact we still don't have a leader there. And thirdly, the economic data. That's a powerful mix. Some people could say, well, hey, is that all in the price now? I would argue no, because I think there's a lot of uncertainty around ECB policy, and actually because they haven't done anything and they've been quite reluctant to ease in the past, what we could see now is some more easing, so them to surprise the market by kind of agreeing to some sort of easing that causes more weakness in euro dollar. Let me just, I just want to also bring up another chart, which, just bear with me, you can see how I even create them. And then I'm going to do, I'm going to do German government debt minus US government debt, because I think in this environment, when you're talking about central banks and how they can impact a currency, it's worth looking at some bond spreads. These are just the 10-year bond spreads. I'll just finish that there. But I just want to show you how they're kind of moving together. So the white line is euro dollar, and the orange line is the 10-year German government bond minus, as kind of benchmark for the eurozone, minus the US government bond, because you can't really do it versus Italy, because obviously there's an individual country credit risk going on there. So I'd rather do Germany versus the US. So as you can see, they kind of move in the same direction. Peaks, a bit lag there, but low peaks. They do kind of move in the same direction, but one thing is for sure: when these bond deals come off, as you can see, as you can see here, as you can see, well, I suppose it happened there. And we saw a bit of a sideways movement, but typically what we see is when these bond yields come up, when this spread comes off, so when it narrows, so when US yields are higher than German yields, it tends to mean a weaker euro dollar. So what we've seen here is euro dollar again climb down a little bit and that to fall as well. Now this isn't perfect. Some of you may say, hang on a minute, the Treasury gets safe haven inflows. I think that's very true. And that is true, which could mess with this spread today, especially with the sequester coming up. However, that should still be euro negative, because actually it could be it could end up being dollar positive. So Black Cat has arrived. Don't worry that you're late. Thank you for joining. Apologies for not making it on Tuesday. I was actually very ill, but I'm better now. Great. So I mean, this to us again, it's kind of a bit like the stars are aligned in our view. And let's just go back to here. So we've got some key levels that I've just spoken to you about. Obviously, this 130.10 mark as a support zone is going to be important, because of course that 130 mark is very important. I mean, we've discussed this. Those who've been joining these webinars for years now, we've discussed this, and it's they're important. I mean, the 130 level is respected. Do I think we can get below there? Absolutely. And I think that it will probably, we've had quite a sharp move lower. If we get that weekly close kind of around about that 130.10 mark, obviously below there would be very bearish. But I think kind of the next key driver, we've got to look at what is the next key driver. I think the next key one could be the ECB meeting, which is next Thursday. I also want to show you this. Okay. We've gone well and truly through the kind of trend line support, which lasted from July last year. So we're well and truly through that. The fact as well that we're through the base of the daily Ichimoku cloud, potentially we could test this 130.10 mark. These are all kind of just confirmations of how kind of weak we are and how close we are to this sub 130 level. In the past, what we've seen is what we've seen in the past is that what we've seen in the past is has been, the ECB stepping in to actually sort out credit risk in the Eurozone, and that when credit risk falls in places like Spain or Italy, that helps push up the euro. That's not what they want to do anymore. They don't want to push up the euro. They seem quite happy to let it slide and try and break growth. From there. Black Cat has just said that kind of closed below 132.50, so this trend line was very significant, and it absolutely was. I think you're completely right there. Again, I think another close below the Ichimoku. Have I got the Ichimoku? Just put it back up. A weekly close below here would be very, very significant. In fact, I want to take a look at the weekly Ichimoku as well. So again, we've gone through the top there, which was a 131.45. So basically, there's an awful lot going on here. Someone's Pan on Fire, sorry, good name, has just said, what will Euro Yen do? I think that's a really good point. Let's take a quick look at Euro Yen. Euro Yen, obviously, I've been saying that it's been like kind of almost the power. So on the way up, it's been kind of like Euro Dollar. It's moved in the same direction, but it's been on kind of steroids, if you like, because the move upwards was so powerful. As you can see here, this is the daily chart from November all the way to kind of earlier this month. We didn't really stop for much breath. The pullback's very, very shallow. Look at that there. Just 107 to a matter of a few pips really on the way higher. We have got this cluster of resistance here, which again marked that's Draghi there. That was when Draghi was speaking at the last press conference, and we have seen a decline. Euro yen is a bit of a different beast actually from euro dollar, and I think from here it's going to be a little bit trickier. I think it will be more supported on the downside than euro dollar, and the reason why is because obviously the Bank of Japan wants to weaken the yen. So for example, on a day like today, we've seen a big move lower in euro dollar. We haven't seen that case in euro yen. So it's actually been kind of the euro and the yen are kind of both quite weak today. So we've seen this more equilibrium come into balance, and I think that's probably what we'll see. And to me, that probably means that we're going to trade sideways. I just want to not perfect, I know, but still. And we have got a bit of a triangle pattern developing here. Key support levels, obviously, kind of 120.30, but all around between there and that kind of 120 zone. A very key psychological support level, which has held so far. If we get below there, I could see us going quite sharply back to 115, but I think that would require an equally violent move lower in dollar yen. And I think added to that, because dollar yen has been targeted so much in this kind of currency war, in what the Bank of Japan are trying to do, that if you're trading any of the yen crosses, you've got to take the lead from dollar yen. So for example, if you're seeing dollar yen continue to rally and potentially if it does get back to that 95 level, then it's going to be hard for euro yen to decline that sharply, but euro dollar could be declining, if you see what I mean, because of the fractal nature of the market. So you've got to look at the big crosses. So when you look at euro yen is an important cross for sure, but euro dollar and dollar yen, they're traded more widely. So look at what they're doing before you're going into euro yen. But I would say though that if we get an overall kind of boost to the yen, and we clear this kind of 120.30 zone, that could potentially open the way back to 115, which is the 100-day moving average, a key level of support. Likewise on the upside, that kind of 124.5 level is now key resistance, and I see us kind of trading in between that level. So very good, maybe less good news if you're a longer term trader trading euro yen, but but there's quite a good range there, quite a defined range if you are kind of the short-term trader. So you can kind of buy it when it gets to these oversold levels, as we've seen people do today, and then sell it when it gets to these kind of highs of 124.5. Someone's just said, do I watch gold as well? I do, and I will talk about gold in a moment. Let's just go back to euro really quickly. So as I said, we've got this kind of 130.10 level, which is this 200-day moving average. Do watch that today, because as I said, weekly close below there is going to be very important. Now, the other big mover today has been pound. Take a look at that. Wow. Just bear with me one moment. Again, the pound's decline has been so sharp. It's made some attempts at trying to recover earlier this week. Like yesterday, for example, we did see it try and get back towards that 152 mark, but it always looked a bit pathetic. Yes, lots of talk of the pound getting pounded recently, or sterling getting a pounding, whatever. I've been guilty of using those myself, those headlines. But I think what we saw earlier this week, this is the daily chart here, was that this recovery zone here just started to look quite pathetic. I am a little bit concerned about where we are. Let me just pull up my RSI. We are starting to look our investors going to want to get in here. I think we're going to need, to get around about sub 150 to get some real extra selling on board. In fact, if anything, I'd say the CFTC data released for this week could, if anything, see just a little bit of scaling back of pound shorts, purely because of a lot of expectation. We know the economy is weak. There's also a lot of expectation of kind of more QE already priced in. I think the market might just be a bit cautious as we lead up to this Bank of England meeting, whereby there's a real chance they'll actually do more QE. On a kind of shorter term level, as you can see, that was the decline. We'd really traded sideways. We'd really traded sideways, but this kind of 152 zone is now massive short-term support. And then looking at it from the downside, you've got kind of 152.20 on the downside. 150.20 on the downside. And where could we go from here? Well, if we got weekly close below 150.20, 149.50 would be the next kind of support level. I completely agree that a high retracement, that would be much nicer for the bears. And again, I think any recovery in the next couple of days leading up to that Bank of England meeting to that 151.90 level, or even 151.50, is going to be met with a lot of selling interest. I think a lot of people will probably add to their pound short as and when we kind of get that pullback. So that's why I would say that a lot of people will possibly hesitant this week to add to pound shorts, because we were at quite stretched levels already. So I think you're right. I think this has been kind of a knee-jerk reaction to what's been going on with the data, that we need to see a bit of a pullback, get in at a better level for the pound. As you can see, very violent move, all down to that PMI data. So a lot of kind of short-term money in there, but the more longer-term players will want to see a bit of a pullback before they extend us below 150. So we might not get there today. The other thing I want to just get you all to be aware of, and actually what's quite handy about us having this on a Friday, is that obviously stays this sequester. Those of you, I'm sure you've all heard the sequester being spoken about. I just have a quick link actually to send you, which is quite a good. It was just from the. Oh no, I can't seem to put that in. Great. It was just from the BBC. Oh, sorry, 1 second. That's actually incorrect. Don't use that link. It's not the full one. Let's just use this one. There you go. This is quite a good BBC description of the sequester and what it is, and you can get more information there. But basically, I think what we're seeing is we've got this sequester. It's quite important. It is important because it's the US's first steps on its fiscal path. Where does it stand? Well, these sequester cuts, so the 85 billion of cuts, they come into play. they come into play earlier. They come into play later today, so I think it's around about maybe midnight US time, and it's 85 billion worth of cuts for this year, which isn't a lot for the US economy, but I think it's more just the fact that it starts the US on a path of fiscal austerity, which it hasn't really been on in any big way or any formal way yet. So that could certainly have when anything that affects the world's largest economy has a big impact on financial markets. That's the way it is. Now, the one thing I would point out is that the US government is, as many of you know, is quite a unconventional, I would say. Not just unconventional, but also fairly dysfunctional, and they have been known to pull things out of the hat at the last minute. So if we get a deal that avoids the sequester, this is the risk now, because I think right now there's little chance of any deal being met, and these cuts will come through and the market will do what it will do. It won't have a violent reaction to the downside. That's not what we expect. What we think will happen, what we think you guys should really be careful of, is that if there is a deal to solve this, there could be some gaps in the weekend. So we could see a bit of a push higher in risk assets, and that could make Sunday's open, so Tokyo's open, pretty volatile. Someone's just asked about Aussie. I did say I was going to talk about Aussie. Let's do it. Aussie's been kind of around about that 102 handles, just got below there now, being pushed lower obviously by this overall surge higher in the dollar. We've got kind of I'm sitting on the fence a little bit with Aussie. I think it could go one way or the other. Obviously this 101.50 is a key support zone. 102.50 has been a good 102.50 has been, fairly good short-term resistance the last couple of days. This is an hourly chart, by the way, that I'm showing you here. So we're getting quite close. Let's just take a look at that daily chart. So as you can see here, bottom of the most recent range. I'm sick of that ray. Let me just change it. Sorry, the extended ray in my on my charts, not any particular ray. Sorry about that. This extended one, it doesn't give you a good clean edge, as you can see. But we're getting very close to a key support level. 101.5 is an important support on the way down. As I said with Aussie, I kind of feel like I want to stay on the sidelines because of the sequester, and we don't know which way the dollar's going to go really. If they do come up with a last minute deal, that could be good news for something like the Aussie, and we might get back towards those kind of, as I said, 102.50 highs. The other thing to note is that we've got an RBA meeting next week. The RBA has had big impact on the Aussie of late. This kind of move downwards was the prospect of them potentially doing some more QE, but then we kind of managed to bounce a little bit off this key support zone, because all of a sudden they were like, actually, you know what, maybe we're not, they don't necessarily sound like they're ready to keep cutting now. Do they think someone's just asked about more bad data to come from Australia? Will China's trade improve? Well, obviously, Aussie's also been hammered a little bit by that weak PMI out of China. China is very, very important for what's going on with Australia, and we do think that the RBA, for example, they're very reactive to what happens in China, to global trade developments. So it is really important. Do they think it's going to improve? Yes, in their last minutes they did. However, because we've got this RBA meeting coming up, I'm waiting on the sidelines to hear what their latest view is, because it may change. As I said, they're very reactive central bank. They're not really like the ECB. It's a completely different approach. It's like if China's going up, that's great. We can have some tighter monetary policy. If it's not, then oh goodness, we've got to cut. And that seems to be a very, very simplistic way of explaining it. But what we have been seeing, I think, is in Aussie is that, it's not only tracking what's going on in China, it's also been tracking what's been going on, domestically. The economic data hasn't been fantastic, but we do have some quite important as I said, some key dates coming up. Obviously, we've got that RBA meeting next week, and then in April we get the quarterly CPI because they release their CPI quarterly. So we don't expect them to do anything next week, but their statement and their guidance will be the most important. We think that they'll probably wait a little bit to get a better handle on global growth, how it's progressing in Q1, and also what inflation pressures are like. The other thing, so that for me, I'm waiting on the fence. What would I do? Well, a break of 101.50 could really see us back down kind of past parity, back to these kind of lows from June, really. For that to happen, we think we probably need about a risk aversion, a big sharp move, push higher in the dollar, in the US dollar. But equally, you know, if we get this kind of sequester, we could get kind of 102.50, maybe back to this key resistance zone here, which is a cluster of daily moving averages. But as you can see, a really defined, a really well-defined range there, and that's why I'm a little bit hesitant with the Aussie. Yes, it has broached that 102 level, but I'm just not 100% sure. I don't feel like that's where the interesting things are going on. That's where the trend is lying at the moment. So that's what's keeping me a little bit sensitive about it. Obviously, waiting for the RBA. If they sound unconcerned, then we could push higher. It could be a good one, a good short-term trade. But again, if they sound a bit worried, then sub parity going back, to these kind of 97-ish lows could certainly be on the cards, especially if we see a bout of risk aversion with that. Now, someone very patiently asked me to talk about gold, and I happily will. All the glitters. Let me just... So this is gold, as you can see here. This is the daily chart. We had tried to rally. It's been kind of up in a topsy-turvy week, I would say, for gold. One of a bit of recovery, the other, and then once we've seen kind of weak inflation pressures build and some kind of more jitters in the markets, then gold has come off. I mean, a lot of people are saying, well, hey, gold doesn't yield you anything. That's why they continue to go into equities. And actually that push higher in equities is quite negative for gold because people are getting out of gold positions and moving into equities on expectations that they'll keep going up. The other fundamental reason I think why gold isn't doing well is that we don't really have inflation pressures. Yes, we have it here in the UK, but they aren't necessarily elsewhere. They're not in the Eurozone, as we just found out, and Ben Bernanke didn't sound worried about inflation at all. One of gold's key uses is as an inflation hedge. So when there's no inflation, you don't need to buy gold. Key level, obviously, 1550, massive support zone here. As you can see, we're kind of fast approaching it, currently around about that 1570 level, and then I do see upside as being quite limited. I'm not a gold bug at the moment. I think that kind of 1625, 1650 level, for me anyway, I think a lot of, if the ECB was to start easing, that could be what pushes gold higher. I'm not 100% sure that they will. I'm certainly waiting for that meeting. So if they were to announce a very big, very aggressive QE program, for example, which I doubt they will, by the way, that could be the next leg higher in gold because that's not really priced in, and gold does react to fresh bouts of QE. However, I do see there being more risk of a downside. I see growth being quite weak. I think when we're in a deleveraging cycle, there's no inflation, and I think that weighs quite heavily on gold. So let's just look even on a weekly chart. As you can see here, that 1550 level is significant over the last kind of certainly 2 years. When you get below there, you're kind of looking sub 1500 towards maybe that 1480 level, and 1450 is this 200-week moving average. So gold can move, gold it can move like, $100 in a day. I would say that kind of, the bias is lower. It could meander down maybe another $100, especially if we see things going as they are, kind of sluggish growth. Yes, there's QE, but maybe the ECB doesn't join in, and there's weak inflation pressure. I just think that maybe the impetus to buy gold isn't quite there. So that to me is the low, but I do think that we're going to meander. It's going to be incremental rather than kind of a big push lower. So it's more one of those kind of buy on, sell on dips, I think. Okay, everyone, that's about it from me. If anyone has any questions, let me know. Happy to take one or two. Thank you, Ray. Yeah, I feel a bit better. Aussie CAD, someone asked. Aussie CAD, yeah, let's take a quick look at Aussie CAD. It's kind of an interesting one, Aussie CAD, because the CAD is very weak. Just get rid of this study. So the CAD is quite weak. So what we've seen is that the Aussie CAD has really been kind of playing it safe within kind of a range, because you've had the two of them really coming in and out of fashion. I actually would, to me, I don't have a clear view on Aussie or the CAD at the moment. As I said, like, you know, I feel like, you know, they're both kind of weak. I'm quite long-term bearish on the CAD, actually, because, you know, the US trade balance, if the US starts producing its own oil, it means it doesn't necessarily need Canadian oil, which could erode the trade surplus, which then could be, you know, negative, which should then be negative, long-term negative for the CAD. But that's all quite theoretical. So I actually prefer, you know, the Kiwi. One thing about the Kiwi has been, you know, so strong. Again, you know, a move back towards that kind of 124 level in Aussie Kiwi, and I think there'll be a lot. That to me is a big selling zone, even especially actually if we get to 125. I think we could see it. You know, Kiwi. There's kind of both countries seem to want a weaker currency, but right now the Aussie is winning that. Added to that, we've seen kind of a little bit more hawkishness out of the RBNZ compared to the RBA, and we've seen some better economic data hold up a little bit better in New Zealand than in Australia. That's been kind of driven. That's what's driven this move. Where are we now? Well, I think we're going to have to wait until next week until we see the RBA. So actually, you know, right now I think because of sequester, I'm thinking sequester, ECB meeting, Bank of England meeting. I'm looking at the major crosses, especially the dollar crosses, the euro crosses. In terms of the commodity block crosses, and relative value trades within the commodity block, they're just not exciting me as much, actually. So that's kind of my take on that. I hope that helped. But everyone, thank you so much for joining, for taking the time to join. We really, really appreciate it. Please do join us next week. It will be Tuesday as usual. And have yourselves a great weekend. Thank you very much.